Well, this time last year, what were we talking about? There's no volatility in the market, right? And 1 year later, look at the 180 degrees we've turned. And so, yeah, there's been a lot of volatility. I think the path has been set by the Federal Reserve, as you were just describing from President Trump. And if that can just sort of, that headwind can lighten a little bit, I think that the market would, stop being so volatile like this.
Low chance of recession in the next, I don't like your time, I want longer. Low chance of recession in the U.S. in the next 3 to 6 months. What about 7 months? I don't want.
Everyone's focused on this yield curve,
right?
And that's what's driving these recession
Could it happen next year, though? Would it surprise you if we had a recession in 2019?
I wouldn't. All of the anecdotal evidence suggests that we're not at a bottom, but closer to the peak, right? Whether it's on employment or, we're in New York City.
Late cycle.
It just all looks like late cycle, as you said. But you have to question the validity of the yield curve as an indicator for recession, given how manipulated the government bond markets have been, not just in the United States, but all over the world. So, I'm not dismissing it out of hand, but maybe the market's a little too anticipatory of a recession because of the signal from the inverted yield curve, or soon-to-be inverted yield curve. But we don't see indications from our companies as far as earnings announcements go or forecasts are concerned. We don't see or hear about any significant deterioration in the economy here or overseas. You do see pockets now. Obviously, the housing market's weakened. If you go to Germany, the German stock market's down like 20-25% from the peak. Italy's, looks like it's on the verge of recession. I mean, you have slowdowns and softening. That's kind of that's part of the economic landscape. But as of now, we don't see broad-based kind of, indications that there's a recession right around the corner.
The point you're making is you invest for the long term. Does that mean that you're comfortable buying here right now? I mean, you point out that emerging markets are cheap too. You buy both right now and wait?
We're at Centerstone, we're value investors, as you mentioned. We're also global investors. So we kind of have a view over the entire world, and our opportunity set is growing by the day because of all this volatility. It was until very recently that most of what we would find would be outside the United States, but now within the last few months, we've actually started to deploy a lot of cash in the United States. So our cash reserves, I started the year with 25% in cash.
Wow, that's a lot.
And now we're down to 15.
Why so much in cash at the beginning of the year? Just valuations?
They just, particularly in the United States. We had no problem finding stuff outside the U.S., but the U.S. market was pretty expensive. The headline number hasn't changed that much. We're 18 or 50, whatever number you want to look at. It's down maybe 10%. Yeah, but earnings are up.
You just said, though, that you still are 15% in cash. So the question is, what are you waiting for?
Well, if this continues, we'll be fully invested. I haven't been fully invested in 10 years.
In 10 years?
Since April of 09.
Okay, so typically, how much do you keep on the sidelines? And by the way, in 10 years, you probably should have been fully invested 10 years ago. Or right after.
It's I wish I was. Right. I wish I had been. Wish I'd known that QE 1, 2, and 3 was around the corner. And...
But of the 15% that's sitting around, your thought is, what are sort of your discipline thresholds for what happens to the market in terms of when you might go in?
We're kind of opportunistic when it comes to this, so it's hard to anticipate what the problem is going to be. But as of right now, I have no problem. We're continuing to put money to work here, as a matter of fact. The market, what it does is it anticipates all of the bad things that can happen, and when it's shocked by an unanticipated outcome, you see this volatility, right? Right now, the market has anticipated so many things, right? Brexit, Italy, Chinese recession, manufacturing, trade talks. I mean, so much has been in the public discourse that it's been, I think, fairly discounted by stocks, even a potentially recession now.
So you think 15% is kind of, it's not even a neutral. It's kind of a bullish. You're already bullish at 15. I mean, people always have some cash.
Well, I'll tell you what. We have 15% in cash yielding 3%.
Right.
That's totally different.
Would you ever? But you would go below that even.
Sure.
Okay.
I mean,
some people just they're going to keep. If they're bearish, they're 50% cash. If they're bullish, they're 10%.
From us, for us, it's just what's available. What's the opportunity set, and as the opportunity set broadens, even in 2007, I had 20% cash. Going into that, not knowing what was about to happen, but is mostly because of valuations. And by the time April comes around of 09, I'm fully invested. So, there is a counter-cyclicality to it. It is almost purely valuation based, though.